What if the financial system you have been told is stable and resilient is actually showing signs of structural failure that the people in charge do not want you to understand? This is not a drill, and this is not exaggeration for the sake of attention. Right now, multiple pillars of the global financial architecture are cracking simultaneously, and the speed at which these fractures are spreading has some of the most seasoned analysts on Wall Street quietly preparing for scenarios they never expected to see in their lifetimes. Let us be very clear about what is happening and why this moment feels different from previous periods of market stress. The American banking sector is under pressure that has not eased since the regional banking crisis that began with the collapse of Silicon Valley Bank. Reports indicate that hundreds of smaller and mid-sized banks across the country are sitting on unrealized losses totaling hundreds of billions of dollars. These losses are hidden in their bond portfolios, and as long as they do not have to sell those assets, the losses remain theoretical. But the moment depositors get nervous and start withdrawing funds, these banks will be forced to sell at a loss, and the theoretical becomes very real, very fast. The Federal Deposit Insurance Corporation has been monitoring this situation closely, and sources familiar with the matter suggest that regulators are far more concerned than their public statements indicate. The commercial real estate market has become a ticking time bomb. At the center of this crisis, office buildings across major American cities are sitting half empty, as remote work has fundamentally changed how companies use space. Property values have collapsed in some markets by 30 to 40%, and the loans backing these properties are starting to default at alarming rates. Regional banks hold a disproportionate share of these commercial real estate loans, and every default puts additional pressure on an already fragile system. Reports suggest that over $1 trillion in commercial real estate loans will need to be refinanced in the next 18 months. And many of these properties are now worth less than the debt they carry. This is a slow-motion crisis that is accelerating faster than anyone predicted. Now layer on top of this the ongoing uncertainty created by the political and legal battles surrounding Donald Trump. Regardless of where you stand on the politics, the institutional reality is that America is projecting chaos to the rest of the world. Foreign investors in sovereign wealth funds do not make decisions based on partisan loyalty. They make decisions based on stability, predictability, and confidence in the rule of law. And what they see right now is a nation where a former president and current candidate faces multiple criminal prosecutions while simultaneously leading in polls for the next election. Sources familiar with international capital flows suggest that this unprecedented situation has created a wait-and-see posture among major foreign investors who would normally be pouring money into American assets. This hesitation matters because the United States depends on foreign capital to fund its deficits and keep interest rates manageable. The Federal Reserve finds itself in an impossible position that grows more dangerous by the week. Inflation remains sticky and above their target, which argues for keeping rates high or even raising them further. But the stress in the banking system and the commercial real estate sector argues for cutting rates before something breaks catastrophically. Chair Jerome Powell has signaled that the Fed is watching data carefully, but officials have stopped providing clear forward guidance because they themselves do not know what comes next. This uncertainty has created volatility in bond markets that is spilling over into everything else. The yield curve has been inverted for a historically long period, which has preceded every major recession in modern American history. Credit markets are showing signs of stress as spreads widen and lending standards tighten. Banks are pulling back on lending, not because regulators told them to, but because they are scared of what is coming. When banks stop lending, the economy slows. And when the economy slows, people lose jobs. And when people lose jobs, they stop paying their debts. And when they stop paying their debts, banks take more losses. This is the doom loop that keeps central bankers awake at night. And right now, every indicator suggests we are moving closer to that loop activating. The Treasury Department has its own problems that compound everything else. The national debt has reached levels that require the government to issue massive amounts of new bonds just to pay the interest on existing debt. But there are fewer buyers than there used to be. China has been steadily reducing its holdings of American treasuries. Japan is dealing with its own currency crisis and has been selling treasuries to defend the yen. And domestic buyers like banks and pension funds are already overloaded with bonds that have lost value. This leaves the Federal Reserve as the buyer of last resort, which means printing money, which means inflation, which means the very thing they have been trying to fight. There is no clean solution to this trap. The stock market has remained surprisingly resilient through all of this, which has led many to believe that everything is fine. But reports suggest that this resilience is concentrated in a handful of mega-cap technology stocks that are masking weakness everywhere else. The equal-weighted performance of the broader market tells a much darker story. Small-cap stocks are struggling. Transportation stocks are signaling slowdown. Consumer discretionary companies are warning about weakening demand. When you look beneath the surface, the picture is far less reassuring than the headline numbers suggest. And throughout all of this, the political paralysis in Washington continues. Congress remains unable to agree on basic fiscal measures. The threat of government shutdowns has become normalized, and the structural reforms needed to address the long-term debt trajectory remain politically impossible. No one in either party is willing to have an honest conversation about what it will take to stabilize the system, because the solutions require sacrifice, and sacrifice does not win elections. What we are witnessing is not a single crisis, but a convergence of multiple pressures hitting the system at the same time. Banking stress, commercial real estate collapse, political instability, Federal Reserve paralysis, Treasury funding challenges, and a stock market that may be disconnected from underlying reality. None of this means collapse happens tomorrow, but it does mean the system is under a level of strain that cannot be sustained indefinitely. And the longer these pressures build without release, the more severe the eventual correction will be. The question is no longer whether the system is stressed. The question is, how much longer can the stress be managed before something gives way?